On October 24th, 1929, a day recorded as Black Thursday, the American financial system ceased to function. In 6 hours, $14 billion in paper wealth evaporated, a figure exceeding the entire valuation of the Canadian economy. A recorded 13 million shares were liquidated in panic. The nation's telephone infrastructure failed under the load, cutting off communication with the stock exchange itself. What internal documents and public records show, however, is that this systemic collapse was set in motion by the decision of a single, powerful individual. His name was Charles Mitchell, the head of National City Bank, known to the press as Sunshine Charlie. He was widely considered America's most popular banker. He was the man who, 7 months earlier, uttered a phrase intended to stabilize the American economy. Instead, that statement activated the mechanism for the most severe financial crash in modern history, triggering the Great Depression. The statistical fallout of that event, which lasted 10 years, is staggering. 25 million people, or 1/4 of the workforce, lost their jobs. 5,000 banks failed, permanently wiping out the savings of millions of families. 2 million Americans were documented as homeless, subsisting in shantytowns bitterly nicknamed Hoovervilles. The suicide rate increased by 30%. In a nation that had, just months prior, considered itself the wealthiest in the world, citizens were reduced to standing in lines for free bread. But what were the mechanics of this failure? The 1920s had been a period of unprecedented economic expansion. The Roaring Twenties, the proliferation of Ford cars, radios, jazz clubs, and skyscrapers fueled a consensus belief that prosperity was permanent. It was into this environment that Charles Edwin Mitchell stepped, born in 1877 to a Massachusetts farmer. His background gave no indication he would become the nation's most influential banker. Yet by 1919, Mitchell headed National City Bank, the country's largest, with $2.7 billion in assets, more than the national budget of most contemporary countries. It was from this position that Mitchell implemented a revolutionary idea. Prior to Mitchell, stock ownership was a privilege of the elite. Records show only 500,000 Americans, less than 1% of the population, owned stocks. The public kept money in banks or bought bonds. Mitchell, however, identified a massive, untapped market. Every American should be a capitalist, he stated. His objective: sell wealth, or the illusion of it, to the masses. In 1920, he created a subsidiary, National City Company. Its mission was direct sell stocks to ordinary citizens inside their local bank branches. When a customer came to open a simple savings account, they were systematically offered an investment in the American dream. Mitchell operationalized this strategy with scientific precision. Studying sales psychology and the specific desires of average Americans, he deployed a new sales force to 69 bank branches. These were not traditional bankers. They were dream merchants, trained via Mitchell's proprietary program. The advertising campaign was equally revolutionary. Newspaper ads, aimed at the working class, read, "Get rich by investing just $15 a month. Become a partner of American Telephone and Telegraph. You're an investor." Magazines were supplied with success stories: a secretary from Ohio who became rich in 2 years, a streetcar driver who bought his own house with dividends. Sales scripts, documented later, reveal the tactics. Mr. Johnson, you don't want to work for someone else your whole life, do you? General Electric stocks? This is your chance. Mrs. Smith, your husband works for Ford. Why don't you become a co-owner? Office posters reinforced the message, showing families with large houses, captioned, Thanks to stocks, we bought our dream home. The core of the machine, however, was a credit scheme. Stocks could be bought on margin. A buyer only had to provide 10% of the cost. The bank loaned the other 90%. The leverage was the entire sales pitch. With $100, one could control $1,000 in assets. A 20% stock appreciation yielded $200, a 100% return on the cash invested. Salespeople used simple, compelling examples. Mr. Brown bought Radio Corporation stocks for $500, investing only $50. In 6 months, they grew by $150. His profit, 300%. Your money in the bank would have brought only 15. The results of this campaign are documented in financial records. Between 1925 and 1929, loans for stock purchases surged from $2 billion to $8.5 billion, a 425% increase in 4 years. The number of stockholders expanded from 500,000 to 10 million. Case files emerged: a teacher mortgaging her home for Radio Corporation stocks, a farmer selling cattle to buy General Motors, a mechanic investing 6 months' salary in Ford. Mitchell was celebrated as a financial genius. His 1928 earnings were $1.2 million, over $20 million in today's currency. Magazines declared he had made every American a potential millionaire. Mitchell then expanded the mechanism, creating investment trusts funds that bought stocks with more borrowed money. These trusts were then structured as joint stock companies, and their own shares were sold, again, on credit. The result was a massive, multi-layered pyramid of debt, entirely dependent on the assumption of perpetually rising prices. By spring 1929, internal documents show even optimistic economists were worried. Stock prices were detached from economic reality. The Federal Reserve System issued an internal alarm the market was overheated. The numbers were stark. Major company stocks traded at 15 times their annual profit, a ratio that, even then, signaled a speculative bubble. On February 6, 1929, the Federal Reserve issued a formal warning to banks to stop issuing loans for speculation. The central bank explicitly demanded a limit on margin lending. The market reacted as expected, and stocks began to fall. In March, billions were lost. Panic grew. The bubble appeared to have burst. Then, on March 12, 1929, Charles Mitchell made his critical decision. At a press conference, he delivered the statement that would define his legacy. National City Bank will provide the market with all the liquidity it needs. We will not allow an unnecessary crisis to occur. The effect was immediate. Newspaper headlines read, "Sunshine Charlie saves the market. Stocks reversed, recovering all losses within a week and surging to new records." Mitchell's statement, investigated later, was found to have triggered the final manic phase. In the summer of 1929, the Dow Jones Index hit 381 points, a record that would not be surpassed for 25 years. An estimated 3 million new investors entered the market in the last months. Reports became common of wives pawning jewelry and shoe shiners giving stock tips. Those already leveraged felt like geniuses. Clerks became paper millionaires. Behind the euphoria, however, was the contractual mathematics of the margin system. Every dollar invested was backed by only 10 cents of real money. A 10% price drop would wipe out an investor's entire position. A 50% drop would leave them owing the bank more than their annual salary. By fall 1929, informed institutional investors grew nervous. They saw 3 warning signs the public missed. First, key economic indicators were deteriorating. Industrial production slowed, car sales fell, and new construction decreased. Yet stocks rose. The gap between market valuation and economic reality was critical. Second, they understood the math. With 90% of the market's money being borrowed, any decline would trigger a catastrophic, self-perpetuating sell-off. As Joseph Kennedy later testified, "When the shoe shiner started giving me stock advice, I knew it was time to sell." Third, insiders knew the Federal Reserve was preparing to raise interest rates, which would make margin loans expensive and force mass selling. These large players began quietly liquidating their positions, selling in small blocks to avoid triggering a panic. By October, patience ran out. Insider information suggested the Bank of England would raise rates, forcing the Fed's hand. On the morning of October 24th, New York's largest investment funds made a coordinated decision to exit the market. They began selling in massive blocks, overwhelming the ticker. Prices began a slow crawl down, which quickly became an avalanche. By noon, panic was total. The record 13 million shares sold overwhelmed the system. The domino effect, built directly into Mitchell's margin system, was launched. The sequence was forensic. First domino, falling prices triggered margin calls from banks. Second domino, investors, lacking cash, were forced to sell, crashing prices further. Third domino, plunging prices made stocks unacceptable as collateral. Banks stopped all lending, cutting off liquidity. Fourth domino, banks overexposed to margin loans, especially those who followed Mitchell's model, began to fail. October 29th, Black Tuesday, was the final liquidation. Another $14 billion was lost, more than the entire U.S. cost of World War I. This financial data obscures the human tragedies. Edward Hopkins, a Detroit mechanic, had $5,000 in Ford stock, his life savings. It fell to $200, and the bank demanded $3,000 more. He was found hanged in his garage. Mary K. Field, an Ohio teacher, lost her parents' mortgaged house. Suicides in New York reached record levels. What accountability did Mitchell face? In 1933, he was called before Congress, asked by Senator Carter Glass if he felt responsible. Mitchell testified, "I wanted to give people the opportunity to get rich. No one forced them to buy stocks." He was subsequently tried for $850,000 in tax evasion and forced to resign in disgrace. The public record shows a divided verdict. The New York Times called him the architect of financial catastrophe. A Detroit newspaper stated, "Charles Mitchell stole more from us than any bank robber. Mitchell took the future from an entire generation." Conversely, many in the business community argued he was a scapegoat, that public greed was the true culprit. Paradoxically, National City Bank itself survived. Deemed too big to fall, it received government support. With Mitchell gone, new management returned to conservative banking. The bank used the crisis to absorb the assets of failed competitors for pennies, emerging by 1935 with an even larger market share. Mitchell lived out his life in obscurity, dying in 1955 at 78, never publicly acknowledging his role in the Depression. The system was forced to react. In 1933, Congress passed the Glass-Steagall Act, separating commercial depositor banking from investment speculative banking, with the stated goal of never again allowing bankers to gamble with depositors' money. The Securities and Exchange Commission, SEC, was created to oversee the market, alongside federal bank deposit insurance and strict margin trading requirements. The government also took a more extreme step. In April 1933, President Roosevelt signed an executive order prohibiting the private ownership of gold. Citizens were required to surrender all gold coins and bars at a fixed price. This move, a desperate attempt to regain control, allowed the government to devalue the dollar against gold, seize the profits, and print money to fight deflation. In 1 month, 600 tons of gold were confiscated. The economic recovery took 10 years. An entire generation lost faith in the financial system. Today, nearly a century later, the parallels are documented. 50 million Americans trade stocks on smartphones. Margin loan volume has hit a record $900 billion. Apps like Robinhood explicitly echo Mitchell's promise to make everyone an investor with zero commissions. A new generation invests in volatile cryptocurrencies and meme stocks, often using margin accounts. The core mechanism, cheap credit fueling mass speculation, is identical. The average American owes more than they earn in a year, and margin trading has returned to 1929 levels. Mitchell's story serves as a case study, a system designed, perhaps with good intentions, to democratize wealth, created a nightmare for a quarter of the population. Every American should be a capitalist, Mitchell said. Everyone should invest. Say today's platforms. History provides a clear-eyed warning and a single lingering question: who will really profit? Subscribe to the channel. There will be many more such stories ahead.